Greetings. This is Market Wisdom for Traders. For stock traders, forex, options, equity, ETFs, futures, commodities, bonds, options, and all chart-related tradings. We are available for training online or live. You can consult us for account management. You are advised to subscribe and share and ask questions. To be successful in the market, you have to be willing to change your opinion. Most people are not willing to change their opinion. You have to be humble about your ideas. Most people are more afraid of making money than losing money. There is a big difference between informed sentiment like CEOs and investors' sentiment. Investor sentiment, however, is usually wrong, at least over the longer term. I judge investor sentiment by one, listening to my own investors. When I start hearing the same comments from a number of my investors, it is a good reflection of what everyone is thinking. If all of a sudden stocks stopped going down on bad news, that would be a positive sign to start long again. Charts are extremely important. One of the best patterns is when the stock goes sideways for a long time in a narrow range and then has a sudden sharp up move on large volume. That type of price action is a wake-up call that something is probably going on, and you need to look at it. Also, sometimes whatever is going on with that stock will also have implications for other stocks in the same sector. It can be an important clue. If you are diversified enough, then no single trade is particularly painful. The critical risk controls are being diversified and cutting your exposure when you don't understand what the markets are doing and why you are wrong. If you are going to control your losses, there will be times when you will get out just before the market turns around. Get used to it. Psychologically, it is extremely painful, but you have to be willing to take your hit. Even when you are wrong in taking your hit, it cleans the slate. And cleaning the slate can be very therapeutic. If you don't clean your slate, you will end up keeping your losses. Some stocks with losses will come back, and you will sell those. But the ones that don't come back, you will end up keeping. Getting out sometimes right before a stock turns is the price you pay to keep your losses under control. Don't try to be 100% right. Instead of making an all or nothing decision when faced with a losing position, begin by liquidating part of the position. It allows the trader to act rather than procrastinate. If the position continues to move against you, liquidate some more. In this way, A losing position is gradually reduced and eventually entirely liquidated if it doesn't turn around, mitigating the damage. The longer the position, the greater the danger that trading decisions will be driven by fear rather than by judgment and experience. Limit your size in any position so that the fear does not become the prevailing instinct guiding your judgment. True to Warren Buffett's investment philosophy, we seek out companies that are selling well below the intrinsic value of their business. Good ideas don't come that often, but the wider you cast your net through reading, screening, and speaking with others, the greater the likelihood that you succeed in finding good ideas. No bell sounds when things get better. This brings us to the end of this episode 35 of Market Wisdom for Traders. Remember to subscribe and share with other groups so as to encourage their growth and progress in trading. Thank you.